gentlemen, good day and welcome to the Creditaccess Grameen Q2 and FY26 earning conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Abhijit Tibrewal from Motilal Oswal Financial Services Limited. Thank you and over to you, sir.
Thank you, Danish. Good evening, everyone. I'm Abhijit Tibrewal from Motilal Oswal, and it is our pleasure to welcome you all to this earnings call. Thank you very much for joining us for the Creditaccess Grameen call to discuss Q2FY26 earnings. To discuss the company's earnings, I am pleased to welcome Mr. Ganesh Narayanan, Managing Director and Chief Executive Officer, Mr. Gururaj Rao, Chief Operating Officer, Mr. Nilesh Dalvi, Chief Financial Officer, Mr. Sahib Sharma, DGM, Investor Relations. On behalf of Motilal Oswal, we thank the senior management and the Investor Relations team of Creditaccess Grameen for giving us this opportunity to host you today. I now invite Mr. Ganesh Narayanan for his opening remarks. With that, over to you, sir.
Thank you, Abhijit. Very good evening to all of you, and I warmly welcome you all to give you an update on our second quarter and first half of FY26 business performance. Firstly, my apologies. This looks like a retake. We finished the entire opening remarks, and as I understand, there was some technical snag due to which you could not hear me, so we are just repeating the speech once again. My apologies for that. So we are pleased to report an improving trend in second quarter performance, reflecting consistent business momentum and stabilizing asset quality. Despite the seasonally weaker nature of Q2, the outcome built on strong trajectory established in Q1 FY26 demonstrates the underlying strength of a customer-centric business model. We continue to operate in an evolving macro environment, and it is encouraging to note that the economic indicators remain supportive. Healthy monsoons, strong agricultural output and strengthening rural ecosystems trends are expected to drive robust on-ground demand in second half of this year, resulting in stronger loan portfolio growth. We disbursed 5,332 crore in the second quarter, which is a 32.9% increase year-on-year. In H1 FY26, we added 4.4 lakh new borrowers, of which 2.2 lakh borrowers were added during the second quarter. Notably, 39% of the borrowers added in Q2 were new to credit, reflecting our customer acquisition strength. With a healthy proportion of new to credit customers being added each quarter, the portfolio share of unique borrowers has risen to 41% compared to 27% in August 24. We continue to strengthen our last mile reach as we open 150 branches during the first half of this year, including 96 during the second quarter, taking our total branch count to 2,209 branches. As stated in the slide 3 of the presentation, the retail finance portfolio share now stands at 11.1% of the AUM at the end of Q2 FY26 versus 6.8% in Q1. Firstly, the RF percentage share optically appears higher given a temporary decline in GL book due to accelerated write-offs. As the GL book growth picks up in H2 FY26, the RF share is expected to show a stable trend. Secondly, the retail finance growth also reflects a well-calibrated strategy driven by disciplined underwriting. Stabilizing PAR trend across our group loan branches and higher regulatory limit for non-MFI asset classes is also enabling us to expand individual business through our group loan branches more effectively. Loan renewals of high vintage group customers with better incomes through individual business loans are also supporting stronger borrower retention. With 45% of the group loan book being 3-year loans, there is a good probability of graduating these customers to retail finance in the near future. The graduation to retail finance would also help in better asset quality, as the individual business loans are displaying relatively superior asset quality due to vintage customers and better underwriting. Our employee base grew from 21,333 in June 25 to 21,701 in September 25, with annualized attrition rate of 28.9% in Q2 FY26. Employee engagement and morale remains strong as we continue to drive steady growth while maintaining a consistent focus on asset quality and profitability. The deleveraging trend is moving on the expected lines, with GLP percentage of borrowers with greater than 3 lenders at 6.9% in September 25 versus 25.3% in August 24. The GLP of borrowers with greater than 2 lakh unsecured indebtedness stood at 7.2% as of September 25 compared to 19.1% in August 24. Further, the average total unsecured debt of CA Grameen borrowers and the average monthly obligation have declined by 2% quarter on quarter. PAR 15 in case of borrowers with 4 lenders stood at 15.1% as of mid-September versus 14.3% in mid-June. Similarly, PAR 15 in the case of borrowers with more than 4 lenders stood at 30.2% in September versus 31.1% in mid-June. This shows that the delinquencies have largely crystallized in case of borrowers with greater than 3 lenders, while 80% of these customers continue to make regular repayments. Our accelerated write-off journey has served its intended purpose by cleaning the legacy stress book and strengthening the foundation for sustainable growth in the second half. In Q2FY26, we undertook write-off of 683 crore, including an accelerated write-off of 554.7 crore related to 180 plus DPD non-paying accounts, leading to an additional credit cost of 172 crore for the quarter. The share of credit cost due to new PAR accretion is consistently declining since Q3FY25. The company continued to hold 150 bps or 383 crore higher provisions over PAR 90 and 268 bps or 681 crore higher provisions compared to IRAC prudential norms and 89 crore higher provisions compared to NBFC provisioning norms. Our collection efficiency excluding arrears stood at 94.5% for Q2FY26. PAR 90 stood at 2.5%, GNPA of 3.65% and net NPA of 1.26%, both predominantly measured at 60 plus DPD. Net interest income grew 4.2% QOQ to 976 crore with portfolio yield at 20.7% and interest spread of 11.1%. Our average cost of borrowing continues its downward trajectory, having declined 11 basis points to 9.6 at the end of Q2 FY26. During the second quarter, we raised 3,519 crore with the marginal cost of borrowing stood at 8.9%. Our foreign borrowing stood healthy at 23.7%, progressing towards our medium-term target of achieving 25 to 30% foreign borrowings by FY28. NIM remains steady at 13.3% for the second quarter. Cost-to-income ratio stood at 32.5, while PPOP stood at 695 crore in the second quarter. The liquidity levels, including cash and cash equivalents, were adequate at 2,176 crore, amounting to 7.9% of total assets. Additionally, we have sanctions in hand of 3,445 crore and another 6,260 crore worth of sanctions in the pipeline. The capital adequacy remained comfortable at 26.1. We delivered a PAT of 126 crore in the second quarter, resulting in an ROA of 1.8% and an ROE of 7.1%. The past few quarters clearly show that the industry has navigated challenges with remarkable resilience and discipline. Portfolio quality continues to improve, supported by prudent underwriting, focused collections, and sharper risk management across the ecosystem. We remain at the forefront of this upward trajectory, creating sustainable value for all stakeholders while reinforcing confidence in the sector's long-term growth. The PAR 15 accretion rate trajectory remained range-bound due to temporary impact of heavy rains, floods across operating geographies. Since the PAR accretion rate is 40-45 bps against 25-30 bps expected, every month of delay in PAR accretion improvement is resulting in an additional credit cost of 15-20 bps. Due to this delayed improvement, we expect an additional credit cost of 40 to 50 bps in FY26. Further, we also anticipate increase in our ECL provisioning rates in line with the recent monthly PD and LGD data points. This would result in an additional 30-40 basis points credit cost impact in FY26. Overall, for FY26, we may see credit cost deviation of 70 to 100 bits as against our initial performance guidance. Further, as we move into FY27, we anticipate another 70-80 bits increase in ECL provisioning rates due to the inclusion of recent monthly PD and LGD data points. Hence, the overall credit cost may range between 4 to 4.5% in FY27, including the one-time ECL rate revision of 70 to 80 bits. Post this revision, the ECL rates should remain range-bound. Amidst the evolving market environment, we continue to leverage our risk-based pricing strategy, low cost of borrowings, and efficient operating structure to protect our ROA in the range of 4 to 4.5%, while being one of the lowest cost lenders in the industry. Before concluding my remarks, I'm pleased to share with you all a significant development in the board. Mr. Manoj Kumar has been appointed as a chairman and independent director. A member of our board since 2019, Manoj brings a rare blend of strategic foresight and entrepreneurial depth. He is the founder of Social Alpha, which is at the core of technology-led innovation, tackling critical social and environmental challenges. He is the founding trustee of the Tata Institute for Genetics and Society, with more than 2 decades of experience spanning banking and capital markets and fintech. Manoj brings the blend of integrity and purpose to his leadership role. Thank you for your patient hearing. We now open the forum for questions and answers.
Thank you, sir. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use headset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Abhishek from AB Capital. Please go ahead.
Hello, am I audible?
Yes.
In Q1, you had indicated that we will grow the book by around 12 to 14% in FY26. So now that in this quarter it was by 3%, can we expect in H2 we will have more than 20% growth, robust growth we will expect?
Yeah. So, Abhishek, we do have visibility on the growth front. In the first half, while you see the disbursements have grown at 27% on a YOY basis, but it has not resulted in growth because of accelerated write-offs. Now, in second half, we will have a normative write-off trajectory. So that is where the disbursement growth will translate into portfolio growth. Largely, we do see we'll be able to meet the growth guidance what we have given.
Okay. And the PAR in MT was showing that it is gradually increasing. Is it something to worry about or it is normal?
So this is something that we are watching. There is a little bit of rain impact here. And also there has been a slight movement in PAR here, but I think there is nothing to worry at this point of time.
Okay. Thank you.
Thank you. Our next question is from the line of Renish from ICICI Bank. Please go ahead.
Yeah, hi, sir. Congrats on a good set of numbers. Sir, just 2-3 things from my side. One on this, the entire credit cost guidance you have shared. So, if I read it correctly, you said that in FY26, our credit cost will be higher by 70 to 100 basis point than the earlier guidance range. Is that the correct?
Yes.
Okay. Now, moving to the FY27, wherein you did mention about the credit cost remaining at 4.5%, which is again 70-80 basis point higher. But I'm not able to understand when you said that the ECL impact, it will be there. I mean, so what should lead to this higher credit cost? When you say ECL refreshment, it is basically you are saying your PD LGD will go up because this year delinquency data will be there in next year ECL model. Is that you are referring?
Yes. So basically the PD and LGDs are moving up, and hence your provisioning rates will also move up because of the recent data points. that will go through the ECL model. We are envisaging that the next year credit cost would be in the range of 4 to 4.5% here. So, Renish, in this, we will see, so like even if you have seen from Q1 to Q2, there has been an increase in our stage 2 and stage 3 provisioning rates. So, this has primarily happened because of increase in the LGD data points. So, even in second quarter, if you see out of the 525 crores of credit cost, there is a 35 crores of credit cost impact on account of increase in LGD rates. And now in third and fourth quarter, we believe that even the new PD points will start getting counted, included in the workings. So that will result in the stage 1, 2, 3 provisioning rates slightly inching up. And then next year, again, there will be inclusion of the PD points. So we don't see any larger change in LGD, but yes, in PD, we will see increase, which will result in increase in the ECL rate. So out of the 4.5 credit cost, maybe around 70-80 bips is the impact because of ECL, which is a one-time impact. And the remaining 3.5 or 3.3 to 3.6, whatever that range is, that is considering the new par accretion. So we have made a little conservative estimate considering that the new par accretion stays around 35 bips per month. But if we are able to improve the new par accretion to the range of 20-25 bips per month, then maybe the number may come lower. So as of now, we have given this figure basis the current trend what we are seeing. We may come up with revised numbers maybe along with our fourth quarter results if we see that if there is any improvement in the monthly par accretion rate.
Got it. So, okay. So just to follow up on that, so when you say that, there will be one-time impact of this entire ECL, refreshment in 27, but then in 28, going ahead also, that PDs will remain in ECL, right? Even if it is on a rolling basis. I'm sure you must be using what?
Yeah, so ECL gets calculated on a longer time period, right? So if you have better performance during the next year, subsequent year, the rates could moderate, but it may take some time to come back to normalcy still. It may not go further because, Renish, it may not go further because this year, the current year's 12 data points will already be part of the computation in the next year. So if next year, if we see the trend reversing, then obviously in FY28, we'll see the ECL rates coming down.
So you are using what, 24 months rolling basis or 36 months rolling basis?
36.
36 months rolling
36.
basis. Okay. Yeah. Got it. Okay. No, this is helpful. And secondly, again on the growth side, adjusted for write-off and all, will be deliver 14-15% growth this year. But what should be your target for next year in 27?
It should be in the range of 20% plus combining our retail finance and microfinance, but I think we should look at guidance by end of the year. But at least the prima facie, we are confident because we've added branches and the momentum is coming back, PAR is normalizing across all geographies. So we should see momentum and we should see growth quite reasonably.
Okay, got it. And just a last clarification, sorry. You said ROA at 4.5% even after adjusting 4.5% of credit cost in 27.
Yes.
Okay. Thank you. And best of luck. Yeah, Nilesh.
So, Renish, basically just to, this will largely be achieved through better operating profit. So even this year, if you see, even in second quarter, despite a 8% annualized credit cost run rate, we have given a 1.8% ROA, which means that we are doing close to 9.5 to 10% of PPOP. And we still see some upward levers in our PPOP because the yields will keep improving as the interest reversal quantum keeps coming down. So in first half, we had a sizable interest reversal quantum, almost 176 crores of interest got reversed, which will not reoccur in the coming quarter. So we will see yield going up. Plus our borrowing cost is coming down every quarter.
So that will also help us to strengthen our NIMs, and even the operating cost will keep coming down. Because in first half, the operating cost is higher because we have added almost 150 new branches, and the portfolio has kind of stayed flat over the last 4 to 6 quarters. So as the growth picks up, we believe the operating cost will again start trending towards our earlier 4.6 to 4.7% levels. So all these factors will offset the higher credit cost. And we believe we should still be, maybe our PPOP will cross 10%. And it will still be able to absorb the credit cost impact and give us the intended ROA.
Got it. Okay. Thank you, Nilesh, and best of luck.
Thank you, sir. Our next question is from the line of Abhishek M. from HSBC. Please go ahead.
Yeah, hi. Good evening. Actually, my question was pretty much just answered by Nilesh. That, the second half should still see the 4.5% ROA achievement which you had guided for last quarter. That's just sort of reconfirming.
Abhishek, this 4.5 we are saying on a steady state basis, but maybe third and fourth quarter we may still it may be slightly lower because the credit cost, the revision in the PD rates will reflect into a slightly higher PCL in third and fourth quarter, and the benefit of pricing will only come gradually. So, like the benefit of pricing, the benefit of borrowing cost, these will play out largely in next year. Though we will still see yields sequentially improving in third and fourth quarter. So that we have also seen the yield improving by almost 40 basis points in the second quarter. So we should see the yields they will keep improving in third and fourth quarter. But I think we may do maybe kind of 4-ish kind of ROAs. 4.5 kind of ROAs may be possible next year.
Okay, because your cost of borrowing should also fall quite a bit because your marginal cost is nearly 70 basis points below your weighted average, plus your yield is improving 30-40 bips, plus the interest reversal almost accounts for 140 bips of yields. So even if that were to come down, you would get a fair bit of release over there. So I thought that it would still be enough to sort of counter your 70-80 bips or 90 bips higher credit cost. Don't you think that?
It will happen, Abhishek. So, it will happen, Abhishek. But the only Abhishek, it should play out. But the only thing is it will be more gradual process. So, while the borrowing cost is coming down, but if you see the weighted average borrowing cost is down by 20 bips in the year. It's not that the entire benefit has flown as of now, because if you look at our borrowings, there is a 65% floating rate borrowings which are linked to MCLR. But these MCLR resets happen over a period of 3 months, 6 months, and 12 months. So we have still not seen the entire repricing benefit. Whatever benefit which you are seeing, which is appearing in our weighted average cost of borrowing, is on account of the marginal borrowing cost coming down. But the existing borrowings will also get repriced over a period of time as we keep hitting the reset dates. So that's where we believe that maybe this year our weighted average borrowing cost started at 9.8, maybe we end the year somewhere at 9.5. So next year we start at 9.5 and maybe we may have an average borrowing cost of around 9.3. So from that perspective, you will see your entire 50 bips of benefit in our cost of borrowing in next financial year. And plus, even on our yields, we will see a similar 50 bips of benefit, and even the OPEX will come down by 20 bips. So that's where we see around close to 100 bips of better operating profit, which will offset the credit cost. So this full impact will play next year. This year in third and fourth quarter, partial impact may play.
Understood. The second question, Nilesh, is on this write-off. So if I look at the presentation, I think it's 680 crores or so overall. I think it is 680, right? Last quarter was 690, it's 680, roughly. So when do you see that number coming off more materially? should we expect that to start coming off in 3Q? And how much of that part 2.5 now, you are there, how much of it is eligible for accelerated write-off?
We may not have, we are largely done with the accelerated write-off cycle. There may be some portion of Karnataka book which we have to see, but largely we are done. So you will not see these figures in third and fourth quarter. The figures will be much lower, much lower.
So the 170 crore accelerated write-off, that should come off materially. And the remaining 500 odd crore, 510 crore, that should also see an improvement because now you are par and forward flows and all of that should be coming down.
Right.
Got it. Third thing is
sequentially also you are seeing that I'm saying sequentially also you are seeing that the new par credit cost due to new par accretion is coming down, right? One of the slides you will see that quarter on quarter the contribution of credit cost due to write-off and par accretion. So that is falling down. It's expected to fall down further in Q3. And since we've done away with most of the accelerated write-off, you will see a much lesser component going forward in accelerated write-off also.
Ganesh, just one thing is confusing me. Maybe I'm looking at it wrong. So your write-off is 690 in first quarter and accelerated write-off out of that is 192. So 500 crores of normal write-off.
No, Abhishek, you are reading it wrongly. So, in second quarter, out of the 680 crores of total write-off, the accelerated write-off is 554 crores. In first quarter, out of the 690 crores of accelerated write-off, around 692 crores of total write-off, around 600 crores was accelerated write-off in first quarter. The 192 and 172 figures, they are basically the credit cost impact. Because when we write off, it will not entirely hit the P&L. Only the unprovided portion will hit the P&L. And typically we'll have 70% provisions in place.
Got it. The third question is your OPEX. Now, if you look at your OPEX to asset, last 5-6 quarters, it had troughed at roughly 4.4 last year, 1Q. And from then, it has continued to go up. Partly, I think it would be because of your base. But is there any other, part of the OPEX which can sort of start coming down? So what parts can you save on and which you are hoping, to drive that improvement in your cost to asset next year?
It is largely due to the AUM decline, right? So otherwise you increase branches, you increase employees, your increments have gone up, but your base has fallen. So as we start building the portfolio size, it should fall back to normalcy in some time. There's no other component which is short term.
Understood. Got it. Thank you. Yeah, those were my questions.
Thank you.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit the question to 2 per participant. Should you have a follow-up question, please rejoin the queue. Our next question is from the line of Dikshant from DB Wealth Management. Please go ahead.
Thank you so much for taking the question, management. So the first question is that the recent sort of environmental damage that we are seeing in Maharashtra, is that concerning to you? And how are we modeling for this right now with the current guidance that we are giving?
You're talking about the rain.